Hey everyone, and welcome. If you're looking to get started in finance and the stock market, you've come to the right place. Today, we're kicking things off from scratch with one of the most powerful tools out there, the P/E ratio. So what if I told you there's one single number that can give you a really quick snapshot of how the market feels about a company? I know, it sounds way too simple to be true, but that's exactly what we're going to unpack today.
That magic number is the price-to-earnings ratio, or just P/E ratio for short. And honestly, the best way to get it is to just forget about stocks for a second. Instead, I want you to imagine you're about to buy your own personal money printing machine.
Now, the formula itself is super simple. It's just the company's stock price, that's what you pay for a piece of the company, divided by its annual earnings per share. Price divided by earnings. P divided by E. You got it.
Okay, so picture this. You're walking around and you find this amazing little machine for sale. The price tag on it says just $2, and the seller tells you, this thing, it'll print you exactly $1 every single year, guaranteed.
Well, in the investing world, that machine has a P/E ratio of 2. Why? Because you paid a price of $2 for annual earnings of $1. 2 divided by 1 is 2. We'd say it has a P/E of 2 times. Simple as that.
And that little number, 2x, tells you something incredibly useful. It's your payback period. At $1 a year, it's going to take you exactly 2 years to make back the $2 you spent to buy it in the first place. Or here's another way to think about it that gets really exciting. Your return on investment, or ROI. A 2-year payback means you're getting a massive 50% return on your money every single year. After year 2, every dollar that machine prints is pure, sweet profit.
A 50% return sounds amazing, right? It kind of makes you think a lower PE is always the way to go. So why on earth would anyone buy a stock with a crazy high PE of, say, 100? Well, to solve this mystery, let's meet 2 very different companies.
First up, we've got the pen company. Let's call this one our honest worker. It's got that nice low PE of 2. It's a solid, maybe a little boring business that just chugs along, making reliable money year after year. Dependable. And in the other corner, we have the AI company. This is our superstar, and it has a jaw-dropping PE of 100. This is the company everyone is buzzing about, the one with the futuristic story and a stock price that's just been going to the moon.
But hang on a second. A PE of 100 means you'd have to wait a whole century to get your money back from its earnings. I mean, who has that kind of time? So what is really going on? Why are people willing to pay such a high price for this company?
The secret is, these 2 companies attract 2 totally different crowds. The pen company, that's for value investors. They care about the dollar the machine prints. But the AI company, that's for speculators. They don't really care about the earnings. They're just betting they can sell the machine to someone else for an even higher price later on.
But here's where the plot thickens. A really high PE isn't always just about wild speculation. There are actually 4 big reasons it can happen, and you gotta know which is which, because 2 are pretty good signs and 2 are major red flags.
So here's the breakdown. The good reasons? Well, investors might be betting that the company's earnings are about to explode. Or maybe the company is smartly pouring all its profits back into growing bigger. But the bad reasons? That's when it's just herd mentality, pure hype, or way too much money chasing just a few trendy stocks.
And you have to be so careful with those bad reasons. Because when everyone piles into a stock based on hype and not on actual results, that's how you get a massive and really dangerous stock market bubble. All right, so we've been looking at the PE for just one company. But what happens when the PE for the entire stock market gets way too high? Let's zoom out now and see the big picture, because this is where it starts to affect everyone.
So when the whole market starts to look like our AI superstar, with payback periods stretching out for decades, regular people start asking a very logical question. They think, why am I taking all this risk in stocks when I can just stick my money in a bank and get a safe, guaranteed return?
And the big trigger for that shift in thinking, it usually happens when the central bank, the big institution that kind of controls the country's money, decides to raise interest rates. All of a sudden, your boring old savings account goes from earning like 1% to a much more attractive 4%.
And the result is huge. It's like a great migration of money. People start pulling their cash out of the risky, high-flying stock market and just parking it in the bank where it's safe. This starves the stock market of capital, and all those high prices start to come down.
And that right there is why a simple interest rate hike is known as the ultimate bubble popper. It's like the little pin that comes along and pops the giant balloon of hype,
bringing everything back down to reality.
So we've seen what it does, but how does this incredibly powerful tool actually work behind the scenes? And more importantly, how does it end up moving the money that's sitting in your own pocket? We are going to dig into all of that in our next explainer. See you then.